This was a mistake. Share screen. See my screen?
Yep.
Can you see my screen?
Yep. You're good.
Let's first, where's my video? Let's first go through some of the questions here, right? So what are the components of value? Why would it be different from price? So that's actually a very important question. So let me stop sharing this for a minute. Let's go over, move the camera, share the whiteboard again. Here we go. Perfect. So you can see that, can you see my cursor on the whiteboard? I don't know if you can or not.
Yes.
So if you want to think about conceptually what fundamental value is, what a value is, right? It's unbiased estimation of discounted future cash flows of the firm, right? Now, right, so if I'm going to now go to the board for a minute and see what is open up. Why is it different than price? Price is simply what people are willing to pay for the firm at a point in time, right? Doesn't mean it's necessarily what we call a reflection of fundamental value, right? But what fundamental value we talk about this ephemeral concept, right? It's kind of like theoretically it exists, practically we don't know how, we don't know for sure whether it is at any point in time. You can see what does this E mean? It means expect. It means there's a certain statistical distribution of probability distribution of cash flow, and that's essentially the expected value, right? And that's an unbiased expectation. What does it mean unbiased? I mean, you learned all the information possible, right? If I wanted to be even more precise here, I would put this bar I. It's a conditional expectation on the known information at the time, right? So I should probably put it everywhere. Right? In other words, I went there, I learned whatever I could about the company, I formed expectations about future cash flows, I developed my forecast of those expectations. I did so in unbiased fashion. I applied a discount rate. We'll talk about discount rate. I developed an expectation of future liquidation value. And that gives me my expectation really of the fundamental value. Right? Now, practically speaking, the other term for this we'll call this is intrinsic value. And in fact, if you go to Asad Damodaran's lecture, it's what he called estimation of intrinsic value. And Damodaran makes a distinction between doing this, and pricing, what he called pricing. What we call in this class comparable companies analysis. Right, or we also call that market-based valuation. Now, what is the basic difference between them? Here in the comparables companies analysis, also precedent transaction analysis, I'm drawing my expectations of value from the market. I'm essentially saying that on average, when I look at comparable companies, I believe market rationally prices these other companies, and therefore will rationally price my company, right? Which may or may not be true. In the case of discounted cash flow valuation and intrinsic valuation, I'm relying on my own expectations. And what are those expectations of future cash flows, of information I obtain? or discount rates, right? So that's the most important difference, right? Ideally, like I said, if you did your job right, in any, by the way, practically speaking, in any valuation reports, both of those things, try to use both methodologies to the extent you can. And if you did your job right, in other words, you didn't mess up on your assumptions, typically you shouldn't be that far off from estimates using one methodology versus the other. They will never be the same. If they're really substantially far off, then you really need to understand why this is. It could happen, right? For example, your multiples might really be swayed by some sort of temporary market conditions, something like that. Maybe the market's overvalued, or maybe you put comparables incorrectly. Or maybe you did something wrong here, right? You either ignored some information or used inappropriate discount rates, or your cash flow assumptions are a little bit, not rational. Maybe they're too aggressive or not aggressive enough. I don't know, right? So it's kind of like if you look at valuation reports or some footnotes in the financial statements that talk about valuation estimates, they'll typically say that we relied on most methodologies. Most methodologies assign more weight to the discounted cash flow valuation simply because it's kind of it's less subject to the market swings, right? But you don't have to, so there's no right, or it's kind of like your judgment call, right? So that's the difference between value and price of the firm, or pricing and kind of intrinsic valuation. All right, let's go back to the slides. Second question, what is the story of GameStop teaching us about the previous questions? What's a short squeeze? All right, so like I said, price is just what market is willing to pay, reflecting at that moment supply and demand on particular shares and particular stock, particular securities. And it doesn't necessarily, it could at times deviate from fundamental value estimates quite a bit. And the story of GameStop is a classic example of that. Because why am I bringing GameStop here? Because GameStop was the case where that company was priced actually completely contrary to its fundamentals. Right? You can Google that story, but basically, GameStop is a store that sells video games. It was closed during COVID, essentially, for all intents and purposes. And a lot of short sellers, those are typically hedge funds, were betting on the price of GameStop to go down, so they were shorting the stock. Shorting the stock is accomplished by borrowing the shares, selling them on the market, selling borrowed shares, with the hope of buying them back at lower prices. And returning them and making money on the difference.
I have a quick question on that.
Go ahead.
So when a firm shorts a stock, do they owe anyone for like the short-term borrowing of that stock?
Absolutely. That's a shorting stock is very costly.
Okay.
Because you have to pay, it's like any loan, you have to pay fairly substantial interest on it.
Yeah, that's what I never really understood about like shorting. Like I knew that you essentially sold the stock and then hope that it would drop and you keep the net, but I wasn't sure like whether it was like an interest rate.
Any loan, and it's fairly substantial, but not just that. That's where I'm going with this.
Okay.
You cannot short for a very long period of time, right? It's kind of a very risky strategy anyway, because I used to work for a hedge fund. My first job in college, I worked as an accountant for a hedge fund. And hedge funds they're allowed to short, unlike stock, unlike mutual funds are not. And I remember one of my bosses told me, what's the difference between shorting, going long, just buying, and low and selling high? What is your downside? Well, the potential downside on going long on the stock is just what you pay for it, right? Downside on the short is unlimited. right? Because if stock keeps going up,
it's kinda like-
it could go up indefinitely.
It's kind of
Well,
like
the
selling
point-
put, right?
It's in fact, you can synthesize a short strategy with options, it's precisely like what you just described, right? Put, of course, is a stock option that gives you the right to sell the stock, right? And a call is the right to buy the stock. And one way to short something is to sell it at a predetermined price. Buy a right to sell at a predetermined price. So therefore, you can't just sit in a short position forever but you get charged interest for it, right? But more importantly, typically the way shorting is accomplished is you borrow shares from a broker. That's what it is, right? So the broker just has some shares that they don't need at a point in time, and they actually let you have them, and you have to buy them back. And if shares go too much in the wrong direction, in other words, they go up rather than down, the broker will force you to close the position and essentially take a loss. Exactly what was happening here, because fundamentally GameStop was clearly overvalued, and they were justified in shorting it. But it was essentially a coalition of kind of retail investors formed on Reddit, and they just kept buying it. They were essentially orchestrated. It was a form of market manipulation that was going to be investigated by the, certainly it was justified to be investigated, not or when. But they essentially got together and said, you know what, we'll keep the short selling. Instead of objectively, the price should go down. Because we're just gonna keep buying it, and we'll drive up the stock. And then it will force these guys to close those positions. They will be forced to buy because of the squeeze. And it will drive, and it will squeeze, they will take huge losses. And on top of it, it will drive up the stock even more because they are forced to buy back. Right, that's a form of, well, I would say kind of questionable, very legally questionable, because it's a form of my mind manipulation. I know it went legally, it's been a while. But that's an example of price being driven entirely by what we call sentiment, right? It doesn't reflect what I wrote on the board at all. And the price is driven purely by people's feelings. And it's funny that I remember somebody was saying, somebody was being interviewed, said, well, we don't care about fundamentals. This is what it is. That just proves that how we feel about it. Who cares, who gives about it, So that's, in some ways, the story of GameStop, and was also the movie theater company. Is an example of opposite of fundamental valuation. All right. Explain what the Modaran means when he says you haven't valued the company, you priced the company. Well, I already explained that on the board, right? When we talk about valuation, we talk about really fundamental valuation, right? When we talk about pricing, we talk about valuation with comparables and so on, right? Why is bias an enemy of the valuation? Well, it's an enemy of the valuation because for you to produce meaningful valuation analysis, you don't want to sway your personal feelings to sway your analysis. You're ultimately trying to say, well, what you're ultimately trying to say through valuation is some way say, okay, well, I think this company is overvalued or undervalued, right? And that's why. But it should be driven by your rational calculation, or, because that's how you arbitrage the stock, right? If you let your personal feelings, your personal biases into this process, you're wrong. You'll lose money. That's that. It's very simple. Why does the valuation setting matter for valuation bias? Well, it depends. What he's saying here, what are you valuation setting is, what are you valuing this stock or this security for? What purpose, right? Is it for kind of retail investment purposes, for minority investment purposes, for majority, for control purposes? What is the subject? If this is not something that's highly tradable, What is the intended use? All of that needs to be factored in your analysis. And in some situations, this valuation bias may influence more or less. What is the role of sell-side equity research analysts? What are YSL recommendations there? So there's buy-side analysts and the sell-side analysts. The sell-side analysts typically work for investment research firms, where they essentially kind of do what we're doing in this class. Is they will cover, about usually it's somewhere around 15 companies. And they're kind of like financial journalists in a way, right? They provide analysis, they provide reports for sale to their clients, which typically are mutual funds or hedge funds or whatever, where they provide, research for sale, essentially. And they typically, an analyst report will contain forecasts of earnings, forecasts of sales, also in many cases something called a target price, which is essentially an estimate of the fundamental value, and the recommendation is buy, sell, or hold company, right? If the firm is undervalued, it's a buy recommendation. If it's properly valued in their mind, kind of vis-a-vis fundamental value, then it's a hold. And if it's overvalued, then it's a sell. Historically, we've seen reasons. Well, they don't like to criticize firms they cover. We can talk about why. It has to do with their incentive structures. Now we see more of them, but in general, it's kind of a sell recommendation today, even though they're more frequent. There's still, it's not like a 50-50 thing, right? It's still maybe far less frequent than buy or hold. Mainly because, when you issue a kind of like you basically, they don't want to like destroy the relationship with it, but firms get upset when they issue sell ratings, right? So it's kind of an extreme event. Why does bias matter in valuation of mergers and acquisitions? Well, interestingly enough, we know statistically that more than half the mergers on average fails. Right? What does it mean, merger on average fail? It means that if you look at, performance over time post-merger, it typically on more than, on average, meaning more than half, I would say roughly, it underperforms the market. Why is that the case? I would say typically because the merger is done for their own reason. So, if you have time, you may want to listen to some of the Damodaran's lectures that I posted. And there's one lecture which I really like that for this class particularly. The intrinsic valuation, right? Which is what discounted cash. An example of like this company shed a lot of money, they had a lot of cash, didn't know what to do with it. And they'll, what is the basic rule of thumb in finance? If you have a lot of cash on hand and you have not been good, to invest it in, just pay it back to shareholders. Either you purchase stock or pay more dividends, whatever, but you only want to spend cash for the positive NPV projects. But what ends up happening oftentimes, companies don't like doing that. They feel like, oh, let's just go make some acquisitions with it, right? It will, because it's CEOs never want to just admit they have nothing better to do with the money. More often than not, unfortunately, these acquisitions end up being value destroying rather than value adding. Now, the question arises why? And you can look at it from the perspective of kind of more selfish CEO incentives, like they just like what's called empire build, right? That's a term that's used in finance. Or that's where bias comes in. Naturally, human beings are optimistic, more optimistic, right? We tend to see the world in a more rosy picture, right? So when they do an acquisition, they want to believe that it will do well, right? And it becomes kind of a self-fulfilling prophecy, rather than to say, well, does it really make sense to do this? Say, well, of course it will do well, right? And then it will build up valuation models, right? Because part of doing an acquisition, you need to do what's called a fairness opinion. They'll get investment bankers to build up valuation, and investment bankers, remember, their incentive is to do a deal, right? They're kind of like, they want the marriage to happen. So they'll write you any model to justify the price, right? So the Damodaran almost says, somehow miraculously, if there's $600 million on the table to be spent, valuation produced by investment bankers will be $600 million, right? No more, no less than that, right? Because they get fees out of it, which is by basis of the price, right? And so they'll kind of fit, I can write, you can do Excel, you can fit any model to get the right number, right? So that's the reason why, right? In other words, this desire to do something with the money then results in biased view, essentially biased modeling, to get yourself to justify the action that you want, rather than to say, okay, well, does this really make sense to do this? Like, is this acquisition really needed, right? Sort of like, I'm sure we'll do this to some degree. We say, oh, I'm gonna go like, I go to Micro Center, like Micro Center, the computer store, and I go and I see another gadget I can buy, right? Like it's like usually for me it's cheap stuff. Like, well, I could really use it. It's $15, right? We can really use it. I'll use it later. Well, I bought this thing; it just sits there 2 years later, right? It's the same thing, right? Like when you want to do something, then you fit your justification for it to wanting to do something. That's a bias, example of a bias, not rational behavior. So in my case, I usually don't buy anything. I say, okay, you know what? I will come back to it later. I will not buy. I always have a rule now. I try not to buy anything impulsively. I just say, okay, if I really need it, I can buy it tomorrow. And the same thing applies to companies, applies to M&A deals in particular. But too often than not, it doesn't necessarily happen because it's kind of companies that because it by other considerations. What is the role of buy-side analysts and how are they different from sell-side analysts? So sell-side analysts, essentially, they work for companies that provide research. And they sell this research to mutual funds, hedge funds, whoever wants to, essentially a subscription-based service, right? Buy-side analysts, we never really see their, and you can see sell-side analyst research by subscription. You can read their reports. We here at the University of Baltimore do not really subscribe to any databases, unfortunately, to do that, but other schools do. But for buy-side analysts, these are analysts that work inside mutual funds, work inside hedge funds. They are internal analysts, right? And we actually don't know much about them at all. So, but they do the same kind of valuation model except internally. Why is it difficult to find a comparable company? What are the different dimensions of comparability? Well, because we talked about it last time. Every company is unique, right? Like in particular today, unless you're a restaurant or I don't know, a company that just sells one product, most larger companies typically do multiple different things, and no company is exactly the same. So then you need to find somewhat similar company on some sort of reasonable set of dimensions. And the more dimensions you want to match it on, the harder it becomes to find a similar company, right? So typically, you kind of have to confine yourself to 3 or 4 similar criteria, right? Criteria of similarity. One, the size, kind of relative profitability, relative riskiness. By riskiness, I mean kind of like similar cash flow patterns, like seasonality of cash flows, maybe similar, we'll talk about beta, things like that, right? And obviously similar industry, right? Like they have to be kind of, there has to be similarity of product market space, maybe similar customers. And once out of that, but the list could go on and on and on. Like I said, there's not that many companies in them, right? For which you have data, right? There's a lot of companies, if you look at the number of businesses in the United States, a lot of companies that are similar. But it also needs to be a company for which you have data, right? You need to have data, you need to have the financial statement data, you need to have pricing data, right? There used to be a public company. It's only about 7,000 to 8,000. I don't know exactly the number anymore. Public companies in the United States, right? And, so it's not like it's that easy. So if you've gotten 3 or 4 reasonably similar comparable companies, that's already good. Right, so is it okay to use public companies as comparables for private companies? So we haven't really talked a lot about private companies because private companies, if you watch a video about private companies, what is the real challenge for private companies? Can somebody tell me? What is the real challenge with value in private companies?
Well, they don't report their like revenues or anything like that.
Yeah, there's no data, right? There's no easily accessible data, right? Unless they give you this data, right? So, but a lot of private companies do have good records, right? But even if you get into that, so there's no prices, most important. There's no comparable prices that you could use, right? As easily. There's a little bit, right? So you can't just use price and base valuations as easily. So typically for private companies, it's perfectly okay to, if you can find a similar public company that has price and data, to use that as a starting point. And what we're going to talk about when we get to that, particularly in the second half of the semester, is that you start with the public company price and data for comparable purposes. And then you make certain judgmental-based adjustments, right? To get yourself to what you believe is a reasonable private company's valuation. But yeah, it's perfectly okay. And in fact, it's necessary most of the time if you to use public companies as sort of guideline companies for private companies, or at least as initial study. The modern set of bias, uncertainty, and complexity are biggest enemies of valuation. Why? All right, so if you think back, let me switch back to the board. Switch back to the board, right? Well, how does, if you think about, let's erase the pricing part. I don't hear it much. Well, it is relevant because, I want to focus in the context of the discounted cash flow. All right, so what does bias mean, right? Bias means that, for example, I can on purpose be too optimistic in my expectations of cash flow. Right, if I know, for example, that this company is like really it's really not a big deal, right? There's nothing really important about it, right? So I shouldn't be too bullish about it. But I'm an investment banker and I really want to do a deal, right? I want to maximize my commission, and my commission is based on proceeds. I'd better. If I have kind of a distribution of outcomes in my head, I'm going to choose more optimistic ones than less optimistic ones, right? That's an example of bias. And in fact, I posted, if you're ever interested, a kind of a research article, which was co-authored by one of my co-authors. They went and read through a bunch of fairness opinions, and they found out that routinely investment bankers use most optimistic assumptions they can possibly do, right? They'll look, let's say when it comes to comparables, most optimistic comparable, right? Because that's what they're paid to do. They want to maximize the proceeds, right? But that's an example of bias thinking, right? Bias, intentional or unintentional, whether they do so. That's right. You ask me why, again, most deals end up being bad. Well, if everybody routinely chooses optimistic assumptions, well, that's it, right? So they overestimate cash flow. Or you could underestimate risk or some discount ratings. Or you can, the other example of bias, when we talk about the information, you only choose, you use, what's it called? Selective vision, right? You tend to focus on things you want to hear and you ignore things you don't want to hear, right? That's an example of bias when you do so intentionally. Now, uncertainty and complexity, that has to do with not intentional desire to overestimate cash flows or underestimate whatever, but that just when things are difficult, to deal with. We tend to make mistakes, right? So uncertainty has to do with difficulty to predict stuff. Let's say a company operates in a very volatile industry. It naturally is going to have more uncertainty because we don't know when things go up or down. It's harder to predict, right? And companies like that, you may make the best effort to be unbiased and still be wrong, and be wrong quite a bit, because you cannot, it's naturally like more difficult, right? So, for example, for that reason, greater uncertainty, firms operating in more uncertain industries routinely have higher R's. Like they routinely have higher cost of capital. Why? Because market essentially saying, well, there's more uncertainty here, there's more risk here. So cash flow, I'm going to assign higher required rate of return to these cash flows because they're uncertain, because I don't know if I'll get them or not. So because there's a higher chance I will not get them. So I want to be compensated more for that uncertainty. Complexity. If it's more complex, it's routinely more difficult to forecast. Think about this, right? So think about forecasting cash flows for a company that sells a single product versus multiple products. It's that simple, right? Right? With a single product, if you reasonably understand this product and the demand for this product and the economy, it's kind of not that bad. Now a company operates in the multiple product space. Suddenly you have to say, okay, well, you know, like how is the relative demand going to be affected? So much more likely to be wrong in that environment. There's nothing particularly insightful here other than that. And questions for the first set of discussions, right? Any comments on that? Checked in generally. Okay. Close attendance. Go to second set of discussion questions. What is the role of investor relations website for public companies? So we're talking about public companies, right? So a big aspect of the first module is gathering information, right? That's the first chapter of Rosenbaum and Pro. So that's why we're talking about this. The first question, so investor relation websites are, all major companies have them. And this is kind of a centralized hub of anything investors want about the company. So you'll find company filings there. You'll find conference calls, recordings there, transcripts of conference calls there. You'll find file. So, you know, that's when you do your analysis, remember, you should all start already thinking about what company you want to write about as part of your project. You should first visit this in the investor relations website, right? What sort of information can you find in the quarterly conference call? What is the typical structure? So a quarterly conference call is a discussion of the quarterly earnings announcement. So it's actually a very important document or whatever. Transcript is a document, you can listen to it. It will discuss the most recent performance comparatively versus the same quarter of last year. That's why management get to present their story. But more importantly, that's where analysts, the sell side analysts, get to ask them hard questions, get to clarify, right? So it's actually a really good source of information and how the company is doing, what's going on with its products. And you know, in the Finance 700, Accounting 635, as part of the course project for that class, I actually require students to listen to last 3 conference calls and kind of gather what's going on. That's kind of a fundamental, you know, element of business analysis for the firm, because that's how you learn what's going on with the business, what's going on with the products, what's going on with the customers. That's why it's very important. What is the difference between quarterly earnings release and the quarterly Form 10K and the 10Q and the 10K? So quarterly earnings release is a voluntary disclosure, it's not required. It is kind of unregulated release of company performance for the quarter. A 10Q is a required quarterly financial filing with the SEC. And hopefully there's no differences between the quarterly earnings call and income, but they do occur, right? And 10K is the company's annual report, right? So it's you typically have 10Qs for the first 3 quarters, and 10K is the fourth quarter, and usually the end of the fourth quarter for the whole year. Most important difference between the 10Q and the 10K is 10K contains audited financial statements, whereas the 10Q they only are reviewed by auditors, they're not actually audited. What are non-GAAP disclosures? How are they different from mandated GAAP disclosures? So a mandated GAAP disclosure is whatever the SEC says you have to put in the 10Q or the 10K, right? But companies also go far and beyond those required by law or required by the SEC regulations disclosures, and they put in all kinds of voluntary disclosures in there, meaning like because they believe they provide more information. So a type of this voluntary disclosure is something non-GAAP, right? Where they'll say, okay, well, we had, let's say, a typical example, they'll claim something, have GAAP numbers somehow do not provide kind of faithful representation of what happened. So maybe there was like a one-time charge or a one-time event that made their income look bad. So they'll provide a non-GAAP disclosure. They'll say, oh, we'll get to adjust for this one-time charge or one-time gain. And most important thing you have to know about the non-GAAP disclosures, also known as pro forma disclosures, is that SEC requires that they be reconciled with the GAAP numbers. They cannot be more prominent than the GAAP numbers. And typically, we know from research that non-GAAP numbers are basically window dressing of performance, right? Everybody wants to just kind of make themselves look better, and they use that but they're legal. So you need to, and the reason why they're legal is that out of the belief that at times it provides valuable information to investors about non-recurring charges and so on, like about more normalized income statements. Our quarterly financial statements audited and reviewed. I already told you they're reviewed. Only 10K is audited. The difference between the audit and the reviews, audit requires much higher level of check-in, much higher level of assurance. We talk about limited assurance for the reviews and reasonable or positive assurance for audited financial statements. So level of check-in for the audits is much higher. With EDGAR, how to use information to find public companies filings data. EDGAR is the centralized repository of all SEC filings that's located on the SEC website. You can go to EDGAR at your convenience, just to see EDGAR. You go to EDGAR, type in the name of the company, and it will tell you, pull out all of their filings, so long as they've been filing with the SEC, which may be 10Q, proxy statements, what have you, right? Whatever they filed will be there. It's like a centralized repository of the information. Companies are required, depending on the type of filing, they are required to file. Let's say the 10K has to be filed with EDGAR on EDGAR within company within 75 to 60. For smaller companies, 90 days or the end of the year. An 8K, which is a significant events file, is filed typically within 24 hours. So just a centralized information hub. What's a large accelerated file or accelerated file? Non-accelerated file will basically answer that already. Depending on the size of revenues and the public float, large accelerated filers would be companies with $700 million or more of what's called public float, which is the form of size estimation. They have more accelerated deadlines for reporting information to the SEC. They're required to file within 60 days. Accelerated filers, 75 days. Small, 90 days. That would be example of 10Ks. What's the structure of a typical 10K? What's an MD&A? Whether you find financial statements in the company in a typical 10K? 10K will contain, first of all, audited financial statements, and that would be kind of towards the back of it. It's item 6. It will contain what's called MD&A, management discussion and analysis. And that's kind of management's commentary on the firm performance. And it will contain a lot of additional required disclosures, which are not in the audited financial statements, but the SEC demands anyway. But for example, company liquidity and risk, that's what you will find in MD. So very relevant if you're analyzing the company and you want to happen through the eyes of management, you need to read the MD&A. Right? It will have value, a lot of information. Financial statements provides strictly accounting data. How is 10K useful in business analysis of the firm? How is 10K be used to identify companies' competitors? Well, because it typically in 10K, most 10Ks will contain discussion of competition and will mention what the company believes are its competitors, right? And that's the population for which you start doing the comparables. If they say this is my competition, so they must be comparable to me, right? So that's the starting point. You shouldn't just take it with a grain. What is the purpose of risk disclosure in 10K? What makes a good risk disclosure? So in the MD&A, SEC requires companies to talk about its risks. What are kind of sources of uncertainty? And a lot of those risk disclosures, unfortunately, are things like, well, we may lose some customers next year, or the economy will go down next year and we'll suffer, right? That's not very useful. But every once in a while, you find some certain risk disclosures which are useful, right? They may suggest that they lost a major they may lose a major contract, or there are problems going on with the employees, what have you, right? So that's why you have to pay attention to what's in them. What are the non-financial metrics disclosed? How are non-financial metrics disclosed in 10K to be used? Are they useful? So, we talk about, ROA, ROE, net income, EBITDA, these are all financial metrics. But for some companies, they're kind of limited use, right? So if you think about, let's say, Netflix, right? What would be an example of a non-financial metric that's useful for Netflix? That's not an accounting measure.
Number of users.
Subscribers, number of users, number of clicks. I don't know what it is, right? So in particular for high kind of tech-oriented companies, or for companies for which there's no long established stable financial history, you start relying on other non-financial metrics, right? So kind of the new economy firms and so on. So or for retail firms might be, number of same-store sales would be an example. Well, this is a financial metric, but kind of a non-GAAP measure, right? Non-GAAP financial metric. What is the purpose of notes to the financial statements? Why are they important? Notes to the financial statements provide kind of the context for how the accounting numbers were prepared, right? What rules were followed? What are financial accounting policies? So it's like gives you context on what the company has done in preparation of statements in accordance with GAAP. What is the purpose of internal control audit opinion? What happens to the company to address internal control opinion? So it's more of an accounting question, but companies of size roughly, if they're in SEC registrants only, and in public companies with size of roughly about 100 million or more in sales, are required to provide annual internal control audits. Internal controls are basically checks and balances of their internal accounting systems that make sure that they produce reliable accounting information. And so auditors have to go ahead and check controls and make sure they operate as designed and they're effective. And if they're not, and it's severe enough, they will issue something called a material weakness report, which is what's called adverse internal control opinion. And what it basically says is essentially that the accounting systems or policies or whatever is applicable in this context, controls that surround production of accounting information are not as reliable as we would like. In other words, there's a higher chance, higher than we're okay with, that financial statements could contain an error in the future. It's kind of a red flag to investors to be more careful, if you will, with accounting numbers with the company, right? And typically, if material weakness report is issued, companies' credit scores suffer, the cost of capital goes up. It's essentially a signal to be more careful with relying on these numbers. Okay? Any questions about this? On the